Good morning, students. Welcome you all once again on the second and last lecture on Ind AS 21, the effect of changes in foreign exchange rates, right? So, as the title suggests, this standard only talks about the foreign exchange implications, right? When the transaction is stated into the foreign currency, when you are a, for example, Indian company, and when you are incurring foreign currency transactions, right? Foreign currency transactions means other than functional currency transactions. And so far, we have well understood what is meant by functional currency, right? So any transaction which is happening in a currency other than functional currency is known as a foreign currency transactions. And foreign currency transactions could be when you are traveling, you are taking, you are spending money in foreign currency, you are purchasing raw material, you are selling, you are doing export sales to the customers, right? You are taking a loan from the foreign country, so these are known as foreign currency transaction. These are examples of foreign currency transaction. The second could be you have a foreign operations. Either you have a branch in USA, you have a subsidiary, joint venture, and associate in, let's say, Germany. So either there could be a separate legal entity or there could not be a separate legal entity, but extension of the main entity, right? When I'm talking about legal entity, I'm talking about separate legal entity. I'm not talking about legal or illegal. I'm talking about whether that entity has its own identity. For example, branch. Branch does not have its own identity, but if there is a subsidiary company, it has its own identity. It has its own SIN number. It has its own income tax number. It has its own different registration, whatever is required. It has its own numbers, right? So if company has a foreign operations, in that case, the company needs to consolidate those financial statement into the entity's financial statement for the purpose of consolidation, right? And when you want to do the consolidation, in that case, you have to convert the foreign operations financial statement into the currency of parent financial statement, right? Into the functional currency, into the presentation currency of parent's financial statement. So in this case, we are going to discuss today how to translate foreign operation financial statement, right? The third piece we will discuss, for example, Infosys. Infosys is listed in USA, right? In India, Infosys is publishing its financial statement into INR. But in USA, Infosys has to publish its financial statement in US dollars because they will not understand rupee. Okay. So in that case, Infosys is required to present its financial statement in US dollars in USA, although its functional currency is INR. In that case, an entity is required to, for example, the entity is a standalone entity, no any subsidiary, joint venture, associate, nothing. This entity has to convert its own financial statement into US dollars, right? It means this entity has to convert its own financial statement from INR to USD, from functional currency to a currency which it has required to present. So in that case, the translation of financial statement into presentation currency rule will be applicable. So in nutshell, point number 2 and point number 3, the rules are similar. In nutshell, the rules are similar. For point number 1, we will be doing the revision and then I'll move forward, right? Then we discuss the objective and scope, right? Then we discuss the some definitions. We discuss what is meant by foreign currency. Foreign currency is a currency which is other than functional currency. What is meant by foreign operation? Foreign operation means a subsidiary, associate, joint venture, or a branch, right? Which is based outside the territory of the parent entity. So what is meant by functional currency? Functional currency is a currency of primary economic environment. What is presentation currency? Presentation currency is a currency in which the financial statements are presented. Okay. We discussed all these things. Then we discussed what is a functional currency, right? And we have discussed, in case of functional currency, we have discussed that what should be the primary indicator, what should be the secondary indicator, and we discussed that the primary indicator you need to look at from the perspective of your output, which is sales, and input, which is direct cost. Okay, your cost of operations. So primary indicator means the indicator which defines that what could be the functional currency, right? And it says that the currency which primarily influences the sales prices, right? In the question, you need to look at that which is the currency in which the sales are denominated and which is the currency in which the prices could be influenced. Okay. So friends, we have done one question as well on this aspect where for the purpose of convenience and consistency, the company has converted the price into US dollar, but the price is influenced by a different market, right? So you need to look at three things, I would say. First, which currency is influencing the prices? Second, in which currency the sales are denominated? Third, in which currency the labor, material, and other cost of providing goods and services are denominated. Okay, is that clear? If the currency in which prices are influenced is not clear, right? In that case, you just need to look at in which currency it is denominated, right? Then secondary indicators will be, once you got the primary indicators, then you have to look at the secondary indicator as well to conclude on the functional currency. And these are the currency in which the financing activities are generated, the currency in which the entity is raising its equity share capital, raising its debt, okay, and the currency in which the receipts from operating activities are usually retained. The receipts from operating activities are usually retained. Okay. So whatever money which is comes in, generally it is retained in that, right? Is that clear? We have discussed a lot of questions on the aspect of functional currency, right? Then we discussed in case of foreign operation, for example, an entity, Reliance, has created a company outside India, and that company is completely dependent on Reliance, right? That company is not doing transaction from anyone outside Reliance. I mean to say, the entire purchases has been made from Reliance India, right? And the entity is selling to the customer. So this entity is working like an agent for Reliance, right? So the all the financial decisions has been taken by Reliance, right? All the basically for the entire operations, this entity is dependent on Reliance. If this entity's cash flow would be impacted, the cash flow of Reliance would be impacted. The proportion of transaction is very high with Reliance, right? And degree of operational independence from parent is not there. It is dependent on parent. It is not independent from parent. It cannot finance its own operations, right? Which says that even though this is a subsidiary, right? This is an entity. This is a company. This overseas company is a company, but still it is working like an agent for the parent entity, right? In this case, the functional currency of this entity will be the functional currency of this parent, right? Sir, but that entity could be in Singapore. Entity could be in UK. In that case, let's say Reliance functional currency is INR. Then how come that entity's functional currency is INR? So going by these conditions, the functional currency would be INR, sir. But how come this US based entity or UK based entity or Singapore based entity will present its financial statement into INR? So friends, that is why I've told you that the functional currency is INR, but they need to present the financial statement in their country on the basis of, if it is Singapore, Singapore dollar, if it is UK, probably pound or euro, if it is USA, probably USD, right? In that case, what will be applicable? The translation of trial balance from INR to the respective currency will be applicable. The translation of financial statement from functional currency to presentation currency would be applicable, which we are going to discuss just after 2 to 3 minutes, right? Is that clear? Then we discuss the foreign operations case study, 2 or 3 case studies, right? Where illustration number 3, we have also discussed from study material in which you have seen that this subsidiary is not dependent on the parent and hence this subsidiary has its own currency, own functional currency, right? Then we have discussed In case of a foreign currency transaction, the initial recognition would be at spot rate. Spot rate means the rate on the date of transaction. Then we discussed if the entity is doing a lot of transactions frequently, then the standard says that the average rate can be applicable on the P&L items, right? It can be applicable on the P&L items, right? Then we discussed the subsequent measurement. Initial measurement is okay, but subsequent measurement. Subsequent measurement, we discussed monetary item and non-monetary item, right? What is meant by monetary item? Where there is a right to receive cash or obligation to pay cash in a fixed unit of currency, right? For example, debtors, creditors, loans. So the fixed unit of currency is there. If I have purchased some goods from Japan, I know that at the time of initial recognition, at the time of acquisition, I know that I need to pay 1 lakh Japanese yen. Doesn't matter what could be the exchange rate of rupee versus Japanese yen, but I have to settle into an amount equivalent to 1 lakh Japanese yen, right? For example, if it is 1:1 ka ratio, so 1 rupee equal to 1 Japanese yen, probably I have to spend 1 lakh rupees. If tomorrow it will become 2 rupees per Japanese yen, I have to spend 2 lakh rupees. But 1 lakh Japanese yen will become constant. It is constant, right? So this is known as a monetary item. What is meant by non-monetary item? Any item which is not monetary is non-monetary. Okay. For example, sir, prepaid expenses. You have already expensed today. You have already incurred money today, right? So now you have to just receive goods or services. Inventory, it is lying in your godown till the time it will not convert it into sale. You will not have a right to receive cash, right? Intangible asset, you are using for obtaining future economic benefit. It is not a monetary asset. It is a non-monetary asset. Advance from customer, is it a monetary asset or non-monetary asset? Advance from, is it a monetary item or non-monetary item? Advance from customer, monetary item or non-monetary item? What is that? So very good morning, Viraj, Nidhi, Namrata, and Tushar. Yeah, good morning, Rohan. Good morning, Radhika and Rahul. Yes, you are right. You're right, Rohan. Advance from customer is a non-monetary item. Why? Because because there is no obligation to pay cash. The obligation is to provide goods and services. It is non-financial and non-monetary, right? You're right, Janvi. Non-monetary. Yes, Prashant, it is non-monetary. Advance paid to supplier. Is it a monetary asset, non-monetary asset? Advance paid to supplier is also a non-monetary asset because there is no right to receive cash. There is a right to receive goods, right? Yeah. Good morning, Prashant. Good morning, Sriram. Yes. Discuss this. Then we discuss, sir, what is the accounting for subsequent measurement, right? So standard says that if it is a monetary item, you have to translate at a closing rate, right? And whatever difference will be there, it will go to the P&L. For example, you have purchased a raw material for 1 lakh US dollar. At the time of purchase, the rate was 60 rupees. But at the time of reporting, the money was outstanding to be payable to the creditor. So, and the rate becomes 62. The creditor is a monetary item. So you have to convert at the rate of 62 rupees. So you will have a loss of 2 lakh rupees as an exchange loss, right? So this exchange loss will go to profit and loss account, right? The non-monetary item. In case of a non-monetary item, you need to just check if the non-monetary item is presented at a closing rate, historical rate. For example, PP, intangible, right? Inventory, if it is at cost model, then nothing is required. It has to be at historical rate only, right? No exchange gain, no exchange loss. Non-monetary item measured at fair value. If the non-monetary item is measured at fair value, for example, inventory is getting converted into cost or NRV, whichever is lower. PP, very classic example, PP has to be converted, let's say on the date of, basically PP has to be restated using revaluation model. So in this case, what will happen? Standard says that when you are doing a revaluation, when you are doing a fair valuation, it means you are replacing your cost as a fair value, right? You are changing your cost. So when you are changing your cost and you are opting for a fair valuation or revaluation model, in that case, you have to restate the non-monetary item using the rate on the date of fair valuation. Sir, in case of PP, if we will opt revaluation model, then my revaluation surplus will go to OCI, other comprehensive income. So where the exchange difference will go? As in monetary item, you told that this will go into P&L, but where the exchange difference will go for this non-monetary item, where I'm doing the revaluation, or right, where I'm doing the subsequent measurement for non-monetary item, where the exchange difference will go. Standard says that exchange difference will go to the same place where the actual fair value changes have been accounted for. So here the exchange difference will also go to other comprehensive income. We have done this case study, right? Case study 7, we have done this. Okay, right? And now let's discuss the translation to presentation currency. Okay, so point number 3 I'll cover first, then point number 2 I'll cover. So I have told you that we will be covering 3 concepts here. One, translation of foreign currency transactions. Then translation of foreign currency, translation of financial statement from functional currency to presentation currency. Third, translation of financial statement of foreign operations to parent currency, right? So first I am covering the translation of financial statement trial balance from functional currency to presentation currency, right? Translation of own financial statement from INR to USD, the example which I have taken in case of Infosys. And I am jumping onto my Excel file. I moved on my Excel file, and this is my Excel file which I presented in the last class. You can see that in days 21 on the request of Sri Ram, I have presented this in a tabular form: foreign currency, functional currency, presentation currency. Then I have also given how to determine functional currency. What are the primary indicators? What are the secondary indicators I have mentioned here? And additional factors in case of foreign operation I have mentioned here, that these 4 conditions needs to be satisfied for taking the foreign operation functional currency same as of parent functional currency, right? Then we have discussed translation of foreign currency transactions, right? And we have discussed the accounting impact, journal entries, balance sheet there. And this is subsequent recognition, where we have discussed in case of monetary item, retranslated at closing rate, impact will go to P&L. In case of non-monetary item, if it is at historical cost, it has to be continued at historical rate. No any exchange difference will be there. If non-monetary item is measured at or retranslated at rate on the date of fair valuation, the exchange difference will go to the same place where the revaluation impact will go. In this case of revaluation impact under Ind AS 16 will go to OCI. The exchange difference will also go to OCI, the example which we have seen in the PowerPoint presentation, right? So now we are discussing the section number 2, item number 2 or section number 2, translation of foreign currency, the translation of functional currency financial statement into presentation currency, right? For example, Infosys is a listed company in India as well as in USA. Infosys in USA, although the functional currency of Infosys is INR, but in USA it has to present its financial statement into US dollar. In this case, this is the one of the important concept, right? Where you can expect some questions as well. So in the translation of foreign currency transactions, you can expect questions, and in this case, you can also expect the questions, right? Yes. So friends, in the last 20 minutes, I have done the entire revision of the last class. and let me know if you have any question so far. Otherwise, I'll move on. Shri Ram is asking, sir, how advance from customer is non-monetary item, since if we provide goods or service and raise bills, it will become debtor and the bill amount will be adjusted against the advance. Shri Ram, the selling of item is a different transaction, right? And giving an advance is a different transaction. First of all, how to identify whether an item is a monetary item or it is a non-monetary item? You need to check the right to receive cash and obligation to deliver cash, right? Let's say you have purchased an inventory. Of course, you will sell the inventory. You know that I have to sell the inventory at 50 rupees. You know the price. So, but whether this inventory is a monetary item, although you will sell the inventory, you will raise the bill, you will get the money. Is it a monetary item? Answer is no. Why no? Because on the reporting date or on the date of transaction, this inventory is your property. You don't have any right to receive cash. How will you say that? किससे लेना है पैसा? Inventory तो गोडाउन में पड़ी है, but can you tell me that I need to receive, I have to receive 50 lakh rupees from Mr. Ram? Can you say that? It will not become monetary till the time you will sell the goods, right? You will sell the goods to the third party. Likewise, if you have, how advance from customer is a non-monetary item. Likewise, you have received an advance from customer, right? You have already received the money from customer. Now, what you are required to pay? You have already received the money, but what you are required to pay? You are required to deliver goods and services, right? You are required to deliver goods and services. And just imagine, once you have received $1 lakh, right? Let's say you have received $1 lakh from a customer or 1 lakh rupee from a customer. That customer is into US and you have to deliver goods to the worth of 1 lakh rupees. If the dollar versus rupee is changing, will there be any impact on you? You don't have to refund the money. You have to deliver the goods and services. For example, today I got the advance from a US based student. Sir, please have this $50,000 or have this 50,000 rupees, right? And I have to deliver the classes on IFRS. Doesn't matter, this dollar versus rupee becomes 60 rupees for $1 or 50 rupees for $1 or 100 rupees for $1. I don't have to deliver any cash in future. I have to deliver goods and services in future. Is that clear? And hence this item is not required to be retranslated on the reporting date. It is not subsequently measured at the reporting date. Okay. Raj, this is the important standard, and generally the questions asked from this Ind-AS 21, right? Generally, you will have 5 to 6 marks question from Ind-AS 21 generally. So maybe this time they would not have asked question, right? But it does not mean that the question will not come from this standard. This is an important standard, right? Yes. So guys, let's move on the Excel file. I believe my Excel file is visible, right? I believe it is visible. Yes. Let's go to the Excel file. So translation of entity financial statement from functional currency to presentation currency. Translation of entity's financial statement from functional currency to presentation currency. Okay. Then what is that? For example, Infosys. Infosys Limited. Listed and incorporated in India. Right? The functional currency is INR. Okay. Functional currency is INR. Okay. Let's say this company is listed in Nasdaq, London Stock Exchange in Japan. So it is listed in Nasdaq, but let's say it is listed in London Stock Exchange, Japan as well. I'm just taking a hypothetical example. So number 1, 2, 3. This company is listed in Nasdaq. Nasdaq is a stock exchange in USA. Nasdaq USA, London Stock Exchange, and let's say Japan, Japanese Stock Exchange, right? So this company is listed in the stock exchanges as well outside India. So the functional currency is INR, but in Nasdaq, this company need to present in USD for US regulators. This company need to present financial statement in US dollar for US regulators, right? Because it is listed in USA. This company has to present financial statement in GBP, pound, for UK regulators, London regulators, Japanese yen for Japanese regulators because they'll not understand INR. Although the functional currency is INR, but it needs to present its financial statement into US dollar, GBP, Japanese yen for different regulators across the world, right? Because it is listed there. It is listed there. Okay. So friends, in this case, this currency this functional currency INR financial statement needs to be translated, the entire trial balance, the entire financial statement, because it has been prepared in functional currency. So now it has to be translated into a US dollar for US, GBP for London, and JPY, Japanese yen, for Japanese stock exchange, right? Now what rules will be applicable, because it is not a foreign currency transaction. You understand, this is not a foreign currency transaction. For example, I am a standalone entity. I have no relationships. I have no relationship outside India. My entire business is within India. Everything is within India. Do I have any foreign currency transaction? Answer is no. But I got listed in Nasdaq. Since I got listed in Nasdaq, I need to file my financial statement also for the US based regulators. So this US based regulator will be requiring my financial statement into dollars, not into INR. So having the functional currency as INR, I need to restate my entire financial statement into US dollars, right? But if I talk about the concept number 1, translation of foreign currency transaction, there is no foreign currency transaction. मेरी तो सारी transaction इंडिया में ही है. But I need to convert this INR to US dollar. And we have discussed that in case of a restatement of foreign currency transaction, monetary item, the impact will go to P&L. But do you think that here simply I am doing translation? If there is any loss or profit, exchange gain, exchange loss, whether it should go to P&L? क्या P&L में जाना चाहिए? It is a notional amount. In case of foreign currency transaction, it was not notional. Because if the debtor is outstanding, creditor is outstanding, loan is outstanding, you have to settle it. And if the dollar will become stronger, you have to incur extra money of INR, extra amount of cash, right? And hence, friends, the standard says that in case of foreign currency transaction, my voice is clear to everyone, guys. My voice is clear to everyone. I hope it is clear to everyone. Is it clear now? Is it clear now? The connection is strong and yes. Okay, thank you. Yeah. So in this case, standard says that you need to translate your financial statement, means you need to translate your balance sheet. You need to translate your P&L. Standard says that the translation rule as per Ind AS 21 needs to be applied for translating functional currency financial statement into presentation currency, right? Functional currency financial statement into presentation currency. Okay. The translation rules as per Ind AS 21 needs to be applied for translating functional currency financial statement into presentation currency. Okay. And what is that? And what is that? So let's discuss. Balance sheet item, P&L item, right? Balance sheet. There is no monetary, non-monetary. Why? Because you are converting entire financial statement. Balance sheet items. Balance sheet item. And what is the functional currency as of now? What is my functional currency? Functional currency is INR. So functional currency is INR. Presentation currency is dollar. Presentation currency is, I'm just assuming dollar, USD, right? This balance sheet item has to be converted from INR to USD at the closing rate. At the closing rate. What is my rate? Closing rate. Closing rate means if you are converting March 23 financial statement, then whatever is the closing rate on 31st March 23, you need to take that closing rate, right? Sir, if we will translate on the closing rate, the difference will arise, right? Where the exchange gain or loss will go, where the exchange gain or loss will go. It will go in other comprehensive income. It will go the foreign currency translation reserve in OCI, in other comprehensive income, because this is a notional one in other comprehensive income, right? P&L, profit and loss items. Functional currency is INR, presentation currency is USD, right? Or let's say for the sake of better understanding, I'll write here as USD, GBP, whatever, it could be anything, or Japanese yen, right? Because I've taken an example of all three in this case. Sir, P&L balance sheet, we understand balance sheet because you are presenting the balance sheet numbers on the reporting date. But P&L is consisting of the transactions for the entire year. P&L is consisting for the transactions for the entire year, right? Transactions for the entire year. So at what rate you have to use to convert this P&L? You have to use the average rate. You can use the average rate, right? For example, the P&L consists of a lot of transactions, the revenue in every month. So if you will apply closing rate, that will not be good, right? So for P&L items, you need to apply average rate, okay? And whatever foreign currency translation reserve, whatever exchange gain or loss will be there, it will go to FCTR, foreign currency translation reserve in other comprehensive income in OCI, right? Is that clear? Is that clear? Yeah. Balance sheet P&L, cash flow and everything is the resulting item. Is that clear? Yes. Let's say you are presenting, you are translating financial statement of for the period ended and as at March 31st, 2023, right? These are the financial statement. You will be preparing the balance sheet, and this balance sheet will be balance sheet as at March 31st, 2023. Your comparative will also be there in balance sheet, right? 22. This balance sheet needs to be converted using the closing rate. Using the closing rate. Closing rate as at 31st March 23. This P&L needs to be converted at closing rate 31st March 22, right? Is that clear? 31st March 22. P&L for the period ended 31st March 2023 and the P&L for the period ended 31st March 2022. Average rate for the entire period, for the entire year. What is the average rate? Average rate for the year 31st March 2023, right? Average rate for the year 31st March 2022. Is that clear? Any doubt here? Is that clear? Yes, other comprehensive income. It's more of a notional nature. It's like a reserve. Other comprehensive income is a reserve. Okay. Is that clear? Great. So we'll understand this thing with the help of an example as well. Okay. Don't worry about that. With the help of illustration. Yeah. I hope it is clear. Translation of translation of entities financial statement from functional currency to presentation currency, and you would have understand why, right? You would have understand why. Now the third concept, translation of foreign operations, right? When I'm talking about foreign operations, I'm talking about the subsidiary, associate, and joint venture. Okay. Is that clear? So this concept we have spoken about the translation of functional currency financial statement into presentation currency. Now the next concept which we are going to talk about, because the exchange the translation is the similar in foreign operations as well. So translation of foreign operations, translation of foreign operations, foreign operation, and the translation rule is exactly cut copy paste. Foreign operation financial statement into parents currency, into parents currency, right? And let me make you understand with the help of a real life example. You all have heard about Reliance Industries. You all have heard about Reliance Industries Limited. Reliance Industries Limited, big company, listed company, RIL. Yeah, you haven't heard about RIL. Let's say RIL. RIL is incorporated into India. Reliance. RIL. RIL is incorporated into India. Incorporated in India, right? What is the functional currency of RIL? Functional currency, INR. What is the presentation currency of RIL? In which currency it is presenting its results? Presentation currency, INR, right? RIL is an Indian company. Although it has a global operations, it is doing a lot of transactions, overseas transactions, but the functional currency of RIL is INR and the presentation currency is also INR. Generally, what happens, friends? Generally, in 98%, 99% cases, in presentation currency will differ. The functional currency and presentation currency will differ if the company is listed in multiple stock exchanges across the world, or the company has got the registration from a different regulators across the world. Like we have discussed about, I hope my voice is visible, my voice is audible. Like we have talked about Infosys. Infosys is an Indian company, but since it is listed in US, so they need to file their financial statement into US dollar as well, right? So in this case, no foreign currency transaction is there, but still they need to convert their financial statement from a functional currency to a different presentation currency, right? Is that clear? Okay. Second, the functional currency and presentation currency is similar, right? But in this case, the foreign operations, which are subsidiary, associate, and joint venture, they need to get consolidated into Reliance, and Reliance is presenting its standalone and consolidated financial statement as per INR only, into INR only, right? Into INR. The standalone and consolidated financial statement into INR. Now what happens? For example, Reliance has three subsidiaries, right? Reliance has three subsidiaries, Subsidy 1, Subsidy 2 and 3. Subsidy 2 and Subsidy 3. Right. It has three subsidiaries. The subsidiary one is in Singapore, second is in US, and third is in Japan. Singapore, USA, Japan. Now, what is the functional currency of subsidiary? What is the functional currency of subsidiary? Functional currency of subsidiary. In Singapore, it is Singapore dollar, SGD. In US, it is US dollar. In Japanese, this is Japanese yen. And assuming that this foreign currency subsidiaries, these subsidiaries are independent subsidiaries. They are managing their financials operations separately, right? They are separate legal entities. They are not extension or agent of the Reliance. So these are the foreign currency subsidiaries. The Singapore entity is a separate legal entity which is maintaining its books of accounts, filing its results, preparing its financial statement in Singapore dollar. Same with USA and same with Japan, right? And there is one Indian subsidiary as well. There is one Indian subsidiary as well, right? So one Indian subsidiary, let's say subsidiary 4. Subsidiary 4. This is in India. Okay. This is Indian subsidiary, right? And this Indian subsidiary is INR. Of course, its functional currency is INR. Okay. Now, friends, since there is an Indian subsidiary, there is no any issue. But what about the foreign currency subsidiary? Okay. For Indian subsidiary, there is no any issue. Just forget about this. Let's talk about these entities. Okay, these foreign currency subsidiary. Now, what happens? Reliance standalone will be in INR. Reliance standalone accounts will be in INR, right? It will be in INR, okay, Indian rupee. And Reliance standalone, I would say, is an INR presentation currency, functional currency. And these subsidiaries, okay, this subsidiaries financial statement is into Singapore dollar, SGD, USD, and Japanese yen, right? In this case, this Reliance standalone plus subsidiary is equal to what? Is equal to Reliance consolidated financial statement, is equal to Reliance consolidated financial statement, right? And is it possible to prepare the consolidated financial statement by adding the financial statement of subsidiary into Reliance Industries standalone, which is having a different currency? For Indian subsidiary, it was possible because the subsidiary is into INR and the parent is also into INR. But for a foreign subsidiary, is it possible to add with the parent currency and just prepare consolidated financial statement? Answer is no. It is not possible. Then what is required? If it is not possible, then what is required in this case? It is required to convert. What convert? It is required to convert the subsidiary financial statement, the foreign operation financial statement, into parent presentation currency. Convert foreign operation financial statement into parent presentation currency. Right? So convert foreign operation financial statement into parent presentation currency, right? Only then it will be possible. Right? If I would say how to prepare consolidated financial statement, I would say Reliance standalone INR, right? Plus subsidiary financial statement converted, financial statement into INR, right? converted financial statement into INR, then it will become your Reliance consolidated financial statement, right? Is that okay? Is that okay? Yes, it can be done. Yes, it can be done, right? Is that clear? Is that clear? Sir, we understood, but how we need to convert this financial statement into INR? Again, what is the rule? What is the translation rule? The translation rule is pretty simple. The translation rule is pretty simple. Balance sheet item, closing rate. P&L item, average rate, right? Rate. Sir, where impact will go? Where impact will go? Impact, exchange gain or loss. It will go the foreign currency translation reserve in OCI. In OCI. FCTR in OCI. Sir, that foreign operation, that subsidiary, associate and joint venture must be having equity share capital as well. Equity share capital. At what rate? It's a balance sheet item, but whether it should be at closing rate, answer is no. Equity share capital will be at historical rate, right? And hence there will be no impact. There will be no impact, right? Equity share capital. Retained earning, opening retained earnings, right? So this retained earning is a accumulation of the profits of different year, right? Opening retained earning will be same as of last closing value, right? Profit for the year, profit for the year, profit for the year. There is a profit for the year, at what value it has to be converted? Of course, if P&L item has to be converted at average rate, by default it will be average rate. By default it will be average rate, right? By default it will be average rate. I'm not writing here. This is bit understood. Okay, friends, the same thing. Yes, sir. Sir, if the subsidiary, associate and joint venture is having any goodwill, then what will be about, what about goodwill? It has to be translated at closing rate, right? The impact will go to FCTR. Is that clear? Is that clear? Any doubt here? Now let's discuss some queries raised by the students. Namrata is saying average rate will be given in question, or we need to calculate. Namrata, average rate will be given in the question. Prashant is saying, sir, where there is a wide fluctuation in exchange rate because of war or other events, will still average rate will be applicable? Prashant, as per standard, if there is a wide fluctuations, right? In that case, standard says that you have to take the rate on the date of transactions. But it is difficult to apply the different rates for a large volume of transaction. In that case, for the sake of convenience, you can take that rate. Otherwise, let's say in question it is written that the average rate for the year is 50 rupees per US dollar. But since there was a war between Ukraine and Russia, and for the first quarter, the rate was 60 rupees per US dollar, right? And in the question, the P&L for a quarter can be identified easily, or it has been given separately. For the P&L for the 3 months has been given, and P&L for the 9 months have been given, right? In that case, for the 3 months P&L, you have to apply the higher rate, which is 60 rupees. And for the remaining P&L, you can apply for 50 rupees, right? So you need to look at that, right? Okay. Namrata is saying, sir, it means in this case, functional currency foreign operations are different from the parent's currency. Yes, Namrata, it could be. It could be. All these big companies are having a lot of foreign subsidiaries. These foreign subsidiaries are having a different functional currency. They will have the same functional currency only if it is acting like a agent. You remember those 4 conditions. It means in this case, yes, Janvi is saying, sir, in case during the new equity shares are being issued, Janvi, in that case, those equity shares has to be issued on the date of rate on the date of transaction. For example, 1 lakh equity shares are very old. So they have to be at historical rate, the rate on the date of transaction, right? And on, let's say, 1st January 2023, 50,000 equity shares have been issued. So on 1st January 2023, whatever the rate was there, it has to be converted on the basis of that rate. Okay, right? But sir, what happened in the next year? In the next year, whatever we have converted initially, there is no subsequent changes. Tushar is saying, sir, what if this exchange difference lead to change profit for the year to the loss for the year? Doesn't matter, Tushar. Doesn't matter, right? And let me tell you, this profit will not convert into loss. Okay. Then you must have the P&L account, right? You must have the P&L account. Let's say in the P&L account, the profit was 10,000 US dollar, and you must have closing retained earning also. And let's say closing retained earning is 25,000 US dollar. And now, Namrata, I'm asking you, what could be the opening retained earning? What could be the opening retained earning? The opening retained earning will be if I have earned $10,000 during the year and my closing accumulated profits are 25,000. It means my opening would be 15,000. So this 15,000 US dollar opening retained earning has to be calculated at the last closing value. Means whatever the last closing value will be there, it will become the opening value. Sir, but I don't have the last closing value in INR. In that case, you can apply the last closing rate for converting this into the last closing value. Is that right, Namrata? Let's discuss a question on this. Let's discuss a question. Okay. Yeah. Just a minute. Friends, let's discuss this. Entity A has a functional currency of INR. Sorry. Entity A has a functional currency of INR. Entity A elects a presentation currency of Euro. Entity A has a US dollar loan, right? Entity A has a functional currency of INR. What is the functional currency? Functional currency is INR. The entity A has decided or elected to present its financial statement into Euro. Presentation currency is Euro. And the entity has a US dollar loan, means there is a foreign currency transaction. See, first of all, you need to be focused about functional currency, because functional currency is a currency in which the financial statement needs to be presented. Financial statement needs to be prepared. So what is my functional currency? INR. Except INR, all is my foreign currency. So this company has decided or elected to present its financial statement into Euro. Euro will be my presentation currency. So from INR to Euro, what will be applicable? Translation of financial statement from functional currency to presentation currency will be applicable, right? The third one is the company has a US dollar loan, which means that this company has a foreign currency transaction. So friends, first of all, what we will do for converting this US dollar loan and recognizing into INR, what will be applicable? Remember the first part. You remember the first part. The foreign currency transaction has to be converted using the spot rate. On the reporting date, if it is a monetary item, it has to be retranslated at a closing rate. If non-monetary item and it is continuing at a cost model, nothing will happen. If non-monetary item is getting captured at revaluation model, then it needs to be retranslated at the rate on the date of revaluation. So friends, there are two legs of this transaction. What are the two legs of this transaction? US dollar loan. needs to be converted into INR, which is a functional currency, using the rules of foreign currency transaction translation, right? Then this INR financial statement need to be translated to euro using the rule of what? Translation of entity's financial statement into presentation currency, right? Into presentation currency. So foreign currency transaction in US dollar, local currency is INR. In this case, this whatever impact will be there for exchange gain or loss, it will go to P&L. It is part of translating foreign currency transaction. Now this functional currency INR financial statement to presentation currency, it will go to FCTR, foreign currency translation reserve, in OCI, where in other comprehensive income. Is that clear? So I have just put this example to make your mind clear that first everything has to be recorded in functional currency. So once you have to, when you have to record everything into functional currency, it is a foreign currency transaction, and the rules of foreign currency transaction will be applicable. Translation rule of foreign currency transaction will be applicable. Once your trial balance is complete, balance sheet have been prepared on the basis of functional currency, now you need to convert to presentation currency. In that case, the translation rule of converting to presentation currency will be applicable. Balance sheet item, closing rate, P&L item, average rate, right? Is that clear? And if it is a foreign currency operation, then if it is a equity share capital, historical rate, opening retained earning, closing value, right? Profit for the year, average rate. Is that clear? Yeah. Yeah, is that clear? So balance sheet, closing rate, P&L, average rate, and exchange difference will be recognized in OCI. Now let's discuss this case study from Institute Study Material. Infotech Global Limited has a functional currency of US dollar, and it needs to translate its financial statement into functional and presentation currency of Infotech Inc. So what is this? This is a case study of translating the functional currency financial statement into the presentation currency or into the parent's currency. Okay. Infotech Global Limited has a functional currency of US dollar, and it needs to translate its financial statement into the functional and presentation currency of Infotech Limited, Infotech Inc. So in the parent. Right? The following balances is given in the books of Infotech Global Limited at the year end prior to translation. So in the functional currency of Infotech Global, the financial statement is given. Now this USD financial statement needs to be converted into L dollar financial statement. Property, plant and equipment is 50,000. It is given. Receivables 9,35,000. Total assets is 9,85,000. Issued capital 50,000. Opening retained earning 28,000. Opening retained earning. P&L means profit for the year is given. Accounts payable is given. Liabilities are given. Total is 9,85,000, right? And the historical rate. Issued capital value is given, which is a historical rate. Opening retained earning value is also given, which is again basically closing value of the last year. Translate the above balances of Infotech Global Limited into L dollar ready for consolidation by Infotech Inc. Share capital and opening retained earnings have been pre-populated, means the number has been given. Prepare a working of the cumulative balance of the foreign currency translation reserve. Now you have to prepare the working for FCTR also, right? Relevant exchange rate are given. You can see that the exchange rates are given. Rate at the beginning of the year, 1 L dollar is equal to 1.22 US dollar. Average rate for the year, 1 L dollar is equal to 1.175 US dollar. Rate at the end of the year, 1 L dollar is equal to 1.13 US dollar, right? This is given. And we know that this balance sheet item needs to be converted into closing rate, which is end of the year 1.13. Profit for the year has to be converted into average rate, which is 1.175. And the opening retained earning is the closing value, which is also given here, which is already given 15,274, and issued capital will be at historical rate. For example, the equity has been issued 10 years back, right? And it is still same. So it has to be at the historical rate. So which is given in the question. So either in the question historical rate will be given or the converted number will be given. Now we need to prepare the financial statement of this entity into L dollar, which should be ready for consolidation into the parent presentation currency, which is L dollar, right? Whether the question is clear? Whether the question is clear? Namrata is asking, sir, is it compulsory to prepare financial statement into functional currency first? Yes, Namrata. Why? Because first you need to, if there is a foreign currency transaction, that has to be converted into the functional currency using the rate of foreign currency versus functional currency, right? And you are aware that the translation of foreign currency transaction rule is different, right? Initial recognition, spot rate, subsequent recognition and measurement, you need to see monetary item, non-monetary item, right? So once that all the transaction has been recorded into the functional currency and trial balance has been completed, then you need to convert this functional currency into a presentation currency, right? In that case, the rule is different. Once you have already recorded all the transactions, your trial balance is complete, your balance sheet is complete. In that case, you need to translate your balance sheet item on the closing rate, P&L item on the average rate, and if there is any impact of exchange gain or loss, it will go to other comprehensive income. Right? It will be other comprehensive income. Janvi is saying, sir, generally how many decimal places are to be used? Sometimes it creates a difference in solution, so it's confusing. So Janvi, I would suggest don't use any decimal, right? If the question, if the number is not given in decimal, don't use decimals, right? If there would be a difference, just put that difference, rounded off the difference, or put the difference into other items, current asset, current liability, and just write the assumption, okay, that there was a difference of 2 rupees, 5 rupees, and we have put that difference into this particular item, right? No one will deduct your marks. So friends, let's discuss this question on the Excel file, and please let me know if my Excel file is visible. This is my question number, case study 3. Case study 3 from ICAI study material. Right? This is my case study 3. Okay. What is my functional currency? Functional currency is US. Functional currency is USD, US dollar. And what is my parent presentation currency? What is my parent presentation currency in which I need to convert? Presentation currency. Again, I'm required to convert. Why? Because for the purpose of my parent's consolidation. It is L dollar. It is L dollar. Right. In this case, we have heard that translation of functional currency to presentation currency, right? Translation of functional currency to presentation currency. What is the rule? Balance sheet at closing rate, P&L at average rate, right? Same rule is there, and the impact will go to whatever the exchange difference is there. It will go to OCI, right? It will go to OCI as foreign currency translation is a FCTR. This is what we are aware. Is that clear? This is what we are aware. Now, first of all, let's present this financial statement into functional currency, then we will convert into presentation currency, right? The closing rate is given. Closing rate is given. What is the closing rate? What is my closing rate? The closing rate is 1.13 US dollar is equal to 1 L dollar. 1.13 USD is equal to 1 dollar, right? And then your average rate is given 1.175 USD is equal to 1 L dollar, right? This information is given. And let's say on 31st March, let's assume 31st March, 20x1. On 31st March 20x1, some balance sheet in functional currency is given, right? So 31st March 20x1, 31st March 20x1, and this is my functional currency. This is US dollar. This is my presentation currency. Presentation currency, which is L dollar, right? Okay. And now my balance sheet numbers. Okay. And let's say this is my exchange rate. This is my exchange rate. Exchange rate. Okay. I'm just telling you how to convert this functional currency translation into presentation, functional currency financial statement into presentation currency. And this is particulars. PP is there, property, plant and equipment is there. Then receivables are there, receivables. Okay. PP is 50,000 US dollar, 50,000 US dollar. And receivable is 9,35,000 US dollar, 9,35,000 US dollars, right? Okay. What is the total? What is the total? The total is 9,85,000 of asset side. Then what is given? Then equity share capital is given. Equity share capital. Opening RE is given. Opening retained earnings is given. Profit for the year is given, right? Accounts payable is given. Accounts payable. Accrued liability is given, right? And what are the balances in dollars in functional currency? It is 50,000, 28,000, 20,000. 50,000 is equity share capital. 28,000 is opening retained earning. Then 20,000 is profit for the year. Although this total makes a closing retained earning. Accounts payable is 8,40,000. And accrued liability is 47,000. Now I have given you the closing rate and the number is matching asset minus liability. Now this balance sheet has to be converted into closing rate. What is the closing rate? 1.13 US dollar is equal to 1 L dollar. So PP has to be converted onto the closing rate 1.13. Receivable on 1.13, right? Equity, again, equity share capital 1.13. No, it is historical rate. And historical rate is given in the question, right? So PP has to be converted at closing rate, right? Receivable has to be converted at closing rate. So 50 divided by 1.13. Receivables 935 divided by 1.13. Okay. Equity share capital, not to convert, right? It has to be at historical rate. Historical rate is given 30,055 in question, right? 300,555. Opening retained earning 28,000. Whether it is required to be converted? Answer is no. Last closing value. It is last year closing value. Last year closing value is the opening value of the retained earning, and it is given in the question, which is 15,274. Right? Profit for the year, average rate. What is my average rate? What is my average rate? 1.175. 1.175. Okay. 1.175. So convert this 20,000 divided by 1.175. It will give you 17,021. Okay. Average rate. Accounts payable, account accrued liability. Again, closing rate. What is my closing rate? 1.13. 1.13. Right. This divided by this. This divided by this. Okay. Your total is 847,306. Your balance sheet was tallied in functional currency, but your balance sheet is out in presentation currency. Why it is out? Can you tell me? If it was tallied in US dollar, why it is not getting tallied in L dollar? Because you can see that because of multiple exchange rate which you are using. For assets, you have used 1.13 closing rate. For liability side, equity share capital, it was a historical rate. I don't know, it was 3-year, 5-year, 10 years older rate, right? Because it is a historical rate. The opening retained earning is on the basis of closing rate, last year closing value, right? Then your profit for the year has to be converted into an average rate which is different from 1.13 closing value. Other liabilities at closing value. Since the multiple exchange rate are getting used here, that is why the balance sheet is not telling. So where the difference will go? Where the difference 24,375 will go? Where? The difference of 24,375 will go. Where? In foreign currency translation reserve. In FCTR, it is part of OCI, right? It will part of OCI reserve, foreign currency translation reserve. And this will be your balance sheet. This will be your differential number. What is that? 871 minus 847,306. 24,375. This is your balancing figure. This is your balancing figure, I would say. Balancing figure. Okay. Right now, you can see that your balance sheet is getting tallied. Right? Is that clear? Is that clear or it is not clear? What is your total of equity and liabilities? Your total of equity and liabilities, the total is 871681 in the presentation currency, right? In the presentation currency. I hope it is clear. Or if the question will tell you that please show the working of FCTR as well. So how to show the working of FCTR? Let's say working of foreign currency translation reserve. Foreign currency translation reserve will arise on the items which are converted into a different rate. For example, equity share capital, opening retained earning, and these items, right? First of all, what is the value of these items in the functional currency? The value is 50,000, 28,000, 20,000, right? Right? Is that clear? Convert these all items into the closing rate. Convert all items into the closing rate. What number will come? This will come, right? What is the total? Now, what is the value of these items? This is given in the question 30,055. This is also given in the question 15,274 closing value. And for this item, what is the value? 17,021 is the value. 17,021 average rate value. The total is 3,223,350. Where the difference will go from closing value to different values, the difference will go to the to the FCTR. 24,375, it is FCTR. FCTR, right? This is my FCTR. This value is same, 24,375, right? So either it could be a balancing figure, or you can calculate this FCTR by applying the closing value to those items on which the closing value has not been applied, right? The differential will go to the foreign currency translation reserve. Yes, I hope you have understood this thing. Rahul, you have to disclose other comprehensive income in the statement of changes in equity, in the reserves and surplus, in other equity, right? Okay. The FCTR OCI will come in P&L. So see, in the profit and loss, I have told you there are two parts. One, profit and loss for the year, then other comprehensive income. So other comprehensive income will separately go to the statement of changes in equity as a separate item, right? Is that clear? Let me show you this thing. Please let me know if the screen is visible for Hindalco Industries Limited. Please let me know. I'm just opening a Hindalco Industries Limited annual report. Are you able to see the Hindalco Industries Limited annual report? Yeah. So let's go to the balance sheet. Yeah. First of all, let me show you the balance sheet. So this is the Hindalco Industries Limited balance sheet. And when you look at the balance sheet, this is my balance sheet. This company has a foreign subsidiary, associated and joint venture. This is the P&L. You can see that this is the profit and loss for the year, right? So this will go to the retained earnings. This will go to the retained earnings, profit and loss for the year. And then there is a separate section for other comprehensive income. And when you look at this section, you will find foreign currency translation reserve. See, foreign currency translation reserve in the other comprehensive income section, right? Foreign currency translation reserves. So I am showing you Hindalco Industries Limited annual report. So this profit for the year 3483, this will go to the retained earning. And this other comprehensive income item will go separately in the reserves and surplus, right? Other than retained earning. Let me show you that statement of changes in equity. This is statement of changes in equity, right? The reserves and surplus. Yeah, you can see that. You can see that this is my retained earnings, and in the retained earnings, you can see the profit, right? The profit which I have shown you, you can see that 3767 profit is there, and retained earning reserves and surplus, retained earning is there in the statement of changes in equity. When you go to the other reserves, you can see this foreign currency translation reserve. This foreign currency translation reserve is other reserves in the statement of changes in equity, in other equity, right? Is that clear? I hope you guys are clear by looking at this live annual report, right? Is that clear, guys? Rahul, is that clear? Namrita, first of all, just think about why this FCTR will arise, why this foreign currency translation reserve will arise. This foreign currency translation reserve will arise because you are translating. Your balance sheet was tallied. Your balance sheet was tallied in the functional currency, but it got unbalanced when you are converting into the presentation currency. Why? Because of different rules. When you prepare balance sheet In balance sheet, some items are coming from the P&L. For example, profit for the year is coming from the P&L. Equity share capital. So everything in the balance sheet has to be restated at closing rate except equity share capital, which is at historical rate, except opening retained earning, which is at the last year closing value. Profit for the year which you have earned during the year, it has to be translated at average rate. Since the rates are different, that is why the difference of 24,375 was coming. You can use this as a balancing figure and show it in the other comprehensive income. In the P&L, you can show this as a other comprehensive income and park it to the other reserves, right? The alternative could be just identify the item where you are not applying the closing rate directly. Okay. In that case, find out if you would have applied the closing rate, then what would be the value? For example, in this case, we have taken equity share capital, opening RE and profit for the year, and we have converted it into the closing rate. The number is coming out at 86,000. But as per the principle of Ind AS 21, we can't do that. That is why we have put the number on the basis of what their rates could be, right? Whatever difference has come, this difference will be shown as a foreign currency translation reserve, right? You can say that either you can use this as a balancing figure or you can use this as a part of your working, right? Is that clear? Okay. Hence, I have explained you that translation of entities financial statement into presentation currency. I'm using word entity, or the translation of foreign operations, be it a subsidiary, joint venture, and associates into the parent's presentation currency, right? I have already explained you these items, and I hope you have understood these items very well. Okay, is that clear? Okay, I have shown you the Hindalco Industries annual report as well, right? This question we have done, and the solution of this ICI study material is also there in my PowerPoint presentation, right? Is that clear? Okay. And now if we are converting the balances of subsidiary into my parent presentation currency, right? So you are aware about the consolidation, and you know that whenever consolidation happens, the intra-group transactions are required to be eliminated. For example, if a parent has given a loan to a subsidiary, right? So in the parent books, it will be asset. In the subsidiary books, it will be liability. So this loan receipt and loan paid has to be eliminated in the consolidated financial statement, right? Because you are preparing the consolidated financial statement as a group financial statement, as a family financial statement. So in the same financial statement, you cannot say that I have given loan to my company. मतलब आप अपने ही फाइनेंशियल स्टेटमेंट बना रहे हो पूरी फैमिली के, तो आप ये नहीं बोलोगे मैंने खुद को लोन दिया और खुद को खुद से लोन लेना है मुझे वापस, right? So this intra-group transaction needs to be eliminated at the time of consolidation, and you all are well aware of. So this concept was there in AS 21 as well, sir. But let's say I have given a loan to my subsidiary, okay? Or let's say if I have sold out goods to my subsidiary. I have sold out goods to my subsidiary, okay? For 1 lakh US dollar, I am into US dollar, my subsidiary is into INR. So I am a parent and I've sold goods worth 1 lakh US dollar to my subsidiary. I am preparing books on the basis of US dollar, and my subsidiary is preparing books on the basis of INR. In US dollar books, I am saying that my trade receivables is 1 lakh US dollar. My subsidiary is saying that my trade payable is, let's say, 60 rupees is equal to $1. So my subsidiary is saying that 60 lakh rupees is my liability, and parent is saying that 1 lakh US dollar is my asset, right? Now, this 60 rupee rate was on the date of transaction. Now closing happens. Subsidiary is closing its books of accounts on 31st March. And on 31st March, the rate becomes 62 rupees per US dollar. So subsidiary is restating, since it is a monetary item and foreign currency transaction was there. When subsidiary is preparing its books of accounts, it is showing at 62 lakh rupees. 62 lakh rupees liability. But the parent is preparing the books in dollar only. So parent is not changing anything because it's dollar only. So parent is saying that I have to receive 1 lakh US dollar. That's all. So now consolidation is happening. Consolidation is happening. And for the purpose of consolidation, this subsidiary entity. So first of all, this subsidiary entity has restated the trade payable. Earlier entry was this subsidiary entity has made an entry. See what subsidiary must have done. The subsidiary has, so let's say the parent, I'll write here the parent. Parent has sold goods worth 1 lakh US dollar. And the time these goods were sold to the subsidiary, the rate was, on the date of transaction, initial spot rate was 62 rupee is equal to $1, 1 US dollar, right? Subsidiary has put an entry, purchases account debit. It is 60, let's say, right? To trade payable, 60 lakh. And this parent has to put an entry, trade receivable, debtor account debit to sales account, 1 lakh, because its functional currency is dollar only. Okay. Is that clear? Is that clear? Now both the entities are settling its books. Both the entities are preparing their closing books of accounts, their books on the reporting date. This parent will do nothing. Why? Because the parent has to receive 1 lakh US dollar, but this subsidiary has to restate. And let's say the closing rate becomes 62 rupees per US dollar. So this subsidiary will do exchange loss account debit in the P&L, exchange loss in P&L account debit, 2 lakh rupees to trade payable, right? Its liability got restated at 62 lakh rupees, and there is a 2 lakh rupees of loss will be there. 2 lakh rupees of loss will be there. Now the consolidation is happening. So first of all, this subsidiary has to translate its INR books into the US dollar. Its INR books into the US dollar, right? So when subsidiary will translate this trade payable of 62 lakh rupees, 62 lakh rupees into the closing rate, it will become 1 lakh US dollar, right? So parent is saying that I have to receive 1 lakh dollar, and subsidiary is saying that I have to pay 1 lakh US dollar. So this transaction will got eliminated. But in the P&L, this exchange loss of 2 lakh rupees has remained because this was debited in the subsidiary's P&L. So in the consolidated P&L, this loss was remained. So friends, intra-group balances are eliminated on consolidation. However, any foreign exchange gain or loss will not be eliminated, right? Why? Because this receivable and payable is within the entity. One has to receive, one has to pay. But the exchange difference is arising, which is outside the group, right? Which is due to the forces outside the group. And let me give you an example. For example, I am a company, I am a parent, and I have 1 lakh US dollar, right? Tomorrow, what I'll do, I'll deposit this money in Indian bank account. I'll deposit this money in Indian bank account, right? And when I'm depositing money in Indian bank account, so I have deposited 1 lakh US dollar, and on that date it was converted and 60 lakh rupees has been deposited in my account. 60 lakh rupees has been deposited in my account, right? When I reach to the closing date, आप समझ रहे हो, 60 लाख रुपए मैंने अपनी इंडिया के बैंक अकाउंट में जमा करा दिए। मैं यूएस की एंटिटी हूं, मतलब मेरा फॉरेन करेंसी बैंक अकाउंट भी है, एंड फॉर यूएस एंटिटी आईएनआर इज द फॉरेन करेंसी. Now, when the dollar becomes stronger and rupee becomes cheaper, what happens? What happens? I will have losses. भाई मेरी जो 1 लाख डॉलर की वर्थ 60 लाख रुपए थी वो कम हो जाएगी. मतलब लेट्स से इंडिया के बैंक अकाउंट में 60 लाख रुपीस पड़े हुए हैं, बट जब मैंने जमा कराया था तब 60 रुपीस की वैल्यू थी. अब मैं 1 साल के बाद निकाल रहा हूं तो बैंक तो मुझे 60 लाख रुपीस देगा ना मेरे बैंक अकाउंट से. लेकिन जब मैं उसको यूएस में खर्च करूंगा तो आज की डेट में तो 60 लाख रुपीस की जो वैल्यू है, उस टाइम पे 60 रुपीस का रेट था, अब 62 रुपीस का रेट हो गया. मीन्स द वैल्यू इन टर्म्स ऑफ डॉलर विल डिक्रीज, राइट? द वैल्यू इन टर्म्स ऑफ डॉलर विल डिक्रीज. इट मीन्स आई विल हैव लॉसेस. So friends, intra-group balances are eliminated on consolidation, but please remember the exchange gain or loss will not be eliminated on consolidation. It will not be eliminated, right? So in the consolidated financial statement of reporting entity, the exchange difference arising on such intra-group transaction is recognized in P&L, right? So this has to be recognized in P&L. Why? It is not a translation difference. It is the actual loss which is happening due to the parent's currency and the other currencies, due to the movement in the parent currency and the other currencies, right? Is that clear? Is that clear, guys? Okay. So let's discuss this illustration number 7, then things will be more clear to you guys. Rahul is asking, sir, what if balancing figure is at asset side? Rahul, there will be a foreign currency translation reserve negative. The foreign currency translation reserve could be negative as well. It will be on the assets, it will be on the other equity it's only, right? It will be in the reserve side with a negative reserve. The functional and presentation currency of parent P is US dollar. The functional and presentation currency of parent is US dollar, like in my example. While the functional currency of subsidiary is euro. Parent sold goods having a value of 100 US dollar to subsidiary when the exchange rate was $1 is equal to 2 euro. Means parent has recorded receivable from S account debit. Parent has recorded in the books of P. What parent has recorded? Receivable from S account debit. Receivable from S account debit, 100 US dollar, 100 US dollar to sales account, 100 US dollar. S has recorded purchases account debit to payable to P in euro, 200 rupees, 200 euro. At year end, the amount is still due and the exchange rate is 1 US dollar equal to 2.2 euro. This parent has to do nothing because parent has to receive 100 US dollar. But this subsidiary has to record in its books of account, subsidiary has to record exchange loss account debit, because this currency becomes cheaper, to payable to P, 20 rupees. This will go to P&L, right? To payable to P. So in this case, when this entity will restate its euro into ISD, US dollar financial statement, this 220 divided by 2.2 will become 100 US dollar. So 100 will got eliminated, but within the group, this 20 exchange loss has been arised. Why? Because there is a movement between US dollar and euro, right? That is why there is a loss within the group due to this transaction. And you can understand this fact with the help of an example. You are a foreigner, you have kept your money in Indian bank account. Whenever the rupee becomes looser, when the rupee will becomes weak and dollar will become stronger, your money in INR will not change. But your purchasing power in US dollar, because you are a foreigner, your purchasing power in US will change. It will diminish. You will have a losses, right? What is the solution given in this case study number 9? In the year end, S should restate its accounts payable to 220 US euro, recognizing a loss of 20 euro in the profit or loss. Thus, in the books of S, the balance payable to P will appear at 220 euro, while in the books of P, the balance receivable from S will be 100 USD. For consolidation purposes, the asset and liability of S will be translated to US dollar at the closing rate. At the time of consolidation, 100 USD, which will get eliminated against the receivable in the books of P, but the exchange loss of 20 euro recorded in subsidiaries P&L has no equivalent gain in the parent's financial statement, right? If this parent would have to restate this one, then of course parent would have gain and subsidiary would have loss, but parent is not required to restate, right? Parent is not required to restate. That is why there is no counter gain, and hence the exchange loss of 20 euro will remain in the consolidated P&L. The reason for this is that the intra-group balance represents a commitment to translate euro into USD, right? And this is similar to holding a foreign currency asset in the books of the parent company. That is, the subsidiary will require to buy 100 US dollar to settle the obligation of the parent, so that the group has an exposure to foreign currency risk, right? So जो English लिखी है, whatever English is written here, this is exactly what I have explained you. Is that clear, my dear friends, or it is not clear? Is that clear or it is not clear? I hope it is clear. I hope it is clear. Yes. You're right, Namrata. Difference in reporting dates. Sir, if I am a parent in India and my subsidiary is preparing 31st December financial statement and I am preparing 31st March financial statement, so reporting entity is, which is INR, is 31st March. Subsidiary foreign operation is 31st December, which is US dollar. So if there is a difference between entities financial statement as per Ind AS 110 consolidation standard, 3 months difference is allowed for consolidation, right? 3 months difference is allowed for consolidation, provided foreign operation to prepare additional statement as of the same date as the reporting entity's financial statement. So this 31st December, the subsidiary is preparing 31st December financial statement. So subsidiary has to catch up till 31st March, additional statement, right? And if subsidiary is not preparing additional statement, the different dates are allowed, provided the difference should not be more than 3 months as per Ind AS 110, right? But if there are significant transactions between these 3 months, in that case, those significant transaction impact needs to be taken. So ये तो consolidation के principle है. But sir, that subsidiary is a foreign subsidiary. So if that subsidiary has to either prepare the additional statement for 3 months, or that subsidiary has to take the significant impact of adjustment in the books of accounts. In that case, how to translate that significant adjustment for the balancing period, or how to translate that additional statement? Simple. Asset and liability at the closing exchange rate. P&L impact at the average rate, right? At the average rate. Same, exactly same, right? This was difference in reporting date. Now, so we have completed translation of foreign currency transaction, translation of entities financial statement from functional currency to presentation currency, translation of foreign operations for the purpose of consolidation to the parent. So we have discussed all these 3 aspects with intra-group balances, with different reporting period. Now we will be discussing what will happen if the parent is disposing of the foreign operations. For example, the parent is closing the branch outside India. The parent is losing control over the subsidiary. The parent is selling the investment in subsidiary. The parent is selling a partial stake in joint venture or associate. This we will be discussing after, let's say it is 8:40 now. We'll discuss this Any doubt in the translation of foreign currency transaction, initial measurement, subsequent measurement, translation of entities financial statement into a presentation currency, translation of foreign operations into a parent's presentation currency, elimination of intra-group balances. There is a concept in case of a difference in reporting period. Okay, everything is clear? Good, great. Yeah. So now let's discuss the disposal of foreign operations, right? Reliance is having a branch in Singapore and now they want to discontinue. So they want to discontinue the assets, liabilities, whatever they have there in the Singapore, right? So if they are having a branch in Singapore, right, and they are disposing of this branch, then of course, if any balances are there in foreign currency translation reserve, so that has to be transferred to P&L, okay? Or there could be, so one, there could be a full disposal. Let's say I am having a subsidiary and I am disposing of my subsidiary, okay? Second, there could be a partial disposal, right? For example, I am having a subsidiary and I'm not disposing 100%, I'm only selling 70% stake, right? So still I'm left with 30% stake, but my control has been lost. Third, I'm having a subsidiary and I was having a 100% control, or let's say 90% control. Now I have sold 30% stake and now I am having a 60% stake. So still I'm controlling, but the only thing is my stake has been reduced, but still I'm controlling. So I have given you three scenarios where one, there is 100% disposal, right? 100% disposal where I have sold my entire stake. Second scenario where I have not disposed of 100%, but I have lost control, right? From 80%, 90% or 100%, I have gone down to 30% now. So I have lost control. Third, from 80-90%, I have gone down to 60%. So my stake has been reduced, but my control has not been lost. Earlier I was controlling, now also I am controlling, right? Only the thing is the stake has been reduced. Means earlier when I was having 80% stake, my minority interest, non-controlling interest was 20%. When I am having 60%, my minority has gone up by 20%, which is now become 40%, right? So friends, we will be discussing what will be the impact of disposal of foreign operations, right? When there is a 100% disposal, when there is a partial disposal. In case of a partial disposal, whenever there is a loss of control or whenever there is no loss of control, we will discuss about the impact with the help of an example, right? So disposal of foreign operations, an entity may dispose completely or partially its interest in a foreign operations through sale, liquidation, right? Through sale, liquidation, or repayment of share capital or abandonment of all or part of that entity. A partial disposal of an entity's interest in a foreign operation is any reduction in an entity's ownership interest in a foreign operation. So partial disposal means reduction in the ownership, right? Reduction in the ownership. Is that clear? Is that clear? Okay. The following disposals, whether complete or partial, are considered to be disposals for the purpose of this standard. Disposal of an entity's entire interest in a foreign operation. Disposal of an entity's entire interest in a foreign operation. Pretty simple, right? Whatever foreign currency translation reserve is there, it will go to P&L. As simple as that, right? Because when you have a interest, when you have a stake in a foreign operation, probably you are consolidating and you are accumulating the difference in the foreign currency translation reserve as a part of other reserve in other comprehensive income, right? So whatever closing balance will be there, it will go to P&L because you have completely disposed of your foreign operations. In case of subsidiary where partial disposal result in the loss of control of a subsidiary. So basically you have partially disposed of and now you are not controlling the subsidiary. You're not controlling the subsidiary. So when you are not controlling the subsidiary, you will not be the You will not be consolidating the subsidiary, right? So जब आप कंट्रोल करते हो तभी आप कंसोलिडेट करते हो, तभी एफसीटीआर आता है. जब कंट्रोल ही नहीं करोगे तो आप कंसोलिडेट भी नहीं करोगे. सो इन दैट केस व्हाट विल हैपन व्हेन यू लूज कंट्रोल, whatever amount of FCTR which was standing, it will go to P&L, right? But what happen if the partial disposal will not resulting in the loss of control of a subsidiary? पार्शियल डिस्पोजल तो किया लेकिन सब्सिडरी पे कोई लॉस ही नहीं, कंट्रोल मेरा लॉस ही नहीं हुआ. Even though earlier I was controlling, now I am also controlling. Earlier I was controlling with 80%, now I am controlling with 60%. कंट्रोल ही नहीं चेंज हुआ, राइट? सो कंट्रोल का परसेंटेज चेंज हुआ बट स्टिल आई एम कंट्रोलिंग. सो इन दैट केस if I have to consolidate again I have to create an FCTR. So in that case, whatever proportionate FCTR is there, the stake which I have lose is 20%. So I have to de-recognize the FCTR to the tune of 20% and recognize as a part of non-controlling interest, right? We'll discuss this. In case of an interest in JV or associate, the partial loss leads to loss of control or significant influence, and such retained interest after the partial disposal become a financial asset. For example, I was having a stake in associate for, let's say, 30% or 25%. I have sold 10% stake, right? So my remaining stake will become a financial asset. So whatever stake I have disposed of, the foreign currency translation reserve to that extent will go to P&L, right? A write down of the carrying amount of a foreign operation is not a partial disposal. For example, you are having 100% stake in a subsidiary, but due to the low growth or due to the bad or poor performance of the subsidiary, you need to impair your investment. In that case, when you're impairing your investment, you're not losing the right to vote, right? You're still having a right to vote. Okay, so charging an impairment is not a disposal. Let's understand this thing with the help of an example and with the help of this table as well. The cumulative exchange gain or loss recognized in OCI, right? So which means FCTR, which is recognized in OCI. So the cumulative FCTR recognized in OCI on disposal of a foreign operation is recognized as follows, right? So you have the FCTR, and when you are completing this, when you are completely disposed of, complete disposal on the disposal of foreign operations directly owned by the reporting entity. So whatever this FCTR is there, it has to be reclassified to profit or loss when the gain or loss on disposal is recognized. Is that clear? भाई मैंने पूरा डिस्पोज ऑफ ही कर दिया. सो जब मैंने पूरा डिस्पोज ऑफ कर ही दिया, in that case whatever FCTR is there, it will go to the P&L. Is that clear? Yes, FCTR will be transferred to P&L when there is a disposal, right? Your FCTR reserve will transfer to retained earning through P&L. Sir, what happens if in case of a partial disposal? On the partial disposal of a subsidiary that includes a foreign operation, right? Proportionate share of the cumulative amount of the exchange differences recognized in OCI to the NCI in that foreign operation. Sir, ये क्या था? So complete disposal means losing the control. Partial disposal means not losing the control. For example, I am talking about this case, right? I'm talking about this case. A minute. I hope my screen is visible now, right? So I'll discuss this with the help of the example in the next slide. On partial disposal of a subsidiary that includes a foreign operation, in other partial disposal of a foreign operations, right? So it is talking about a subsidiary, it is talking about JV or associate. So in case of a subsidiary, if there is a partial disposal and still it is a subsidiary, then whatever the difference amount is there from the partial disposal, that FCTR will go to non-controlling interest, right? In case of a JV or associate, the entity shall classify to P&L only the proportionate share of the cumulative amount of the exchange difference recognized in OCI. I will explain these two parts. Let's understand with the help of this example. Parent P owns 100% stake in a foreign subsidiary, right? Parent P owns 100% stake in a foreign subsidiary. It was wholly owned subsidiary. P sells 70% of stake and loses control over S, right? Loses control over S. Lost control means, when I'm saying it is a lost control, means complete disposal. So lost control means you will not consolidate this subsidiary further. Lost control means no consolidation. No consolidation further means there is no requirement for a subsidiary, for this subsidiary to translate their financial statement into the parent currency, and parent is not required to consolidate. So in that case, whatever FCTR is there till the time of disposal, that entire FCTR balance recognized in OCI will transfer to the profit or loss as a other income or other expenses. Is that clear? Is that clear? Sir, if it would not be the subsidiary, if it would be the branch only, then of course, if the company is disposing of the branch, whatever net gain or loss will be there, that will go to the P&L, right? I hope it is clear. I hope it is clear. I'm talking about derecognition, disposal. Okay. Thanks, Radhika. Thanks for the great feedback. Parent P owns 100% stake in a foreign subsidiary. Parent P owns 100% stake in a foreign subsidiary S. The stake is 100%. Now P sells 10% of its investment and retain control over S. So earlier the stake was 100%, right? Now it goes down to 90%. It goes down to 90%. So still control is there. Means control is there means consolidation will be there. So in this case, for example, at 100% stake, the foreign currency translation reserve, for example, at 100% stake, the FCTR was 1000 rupees. The FCTR was 1000 rupees. So how much stake the company has lost? 10%. What is the pro rata amount of 10%? What is the pro rata amount of 10%? 100 rupees, right? So this 100 rupees will transfer from FCTR and will go to the non-controlling interest NCI. It will be added to NCI. In this case, 10% of the balance lying in the foreign currency translation reserve will be reclassified to non-controlling interest. So it is within equity. It is not P&L. It is within equity. So in that case, what will happen in this example? In this example, my FCTR will be 900 rupees. My NCI will be adjusted by 100 rupees, right? Is that clear? Is that clear or not clear? Friends, I'm not getting a response. Radhika, I haven't received response from anyone. If you'll not tell me, I'll not be able to know whether you have understood or you have not understood. Yeah. I'll just take a 10 seconds pause. Rahul is saying clear, sir. Okay. Is that clear? Okay. So I've received 6 responses now. Okay. Let's move on. Third one, parent P. So you remember, one is complete disposal. The second one is partial disposal of subsidiary, which is not resulting in loss of control. Sir, if this 100% become 90%, what happens if this 100 become 40? Then it will go to the first case. Okay. Third one, parent P owns 35% stake in foreign associate Q. Means it is a JV and associate arrangement. P sells 5% stake and retains significant influence over Q. It is still an associate. So earlier the stake was 35%. Now it has gone down by 30%. Right. For example, during the consolidation, for this 35% stake, the FCTR for this 35% stake, for example, the FCTR was 100 rupees, right? And the company has sold out 5% stake. It means the company has to transfer 100 multiply by 5 divide by 35. It means the company has to transfer for 35% stake, FCTR is 100. So for 5% stake, what is the FCTR? So 100 multiplied by 5 by 35, which comes out as around 14 rupees, right? This 14 rupees will transfer to P&L. This 14 rupee will transfer to P&L, as simple as, right? Sir, in the second case, you have directly done 10%, but here you are doing 5 by 35. I'm just applying unitary method. अगर 100% का FCTR 1000 रुपए तो 10% का कितना होगा? अगर 35% का FCTR 100 रुपए है तो 5% का कितना होगा? So whatever stake you have transferred, I'm just reclassifying that FCTR to P&L. That's all. That's all what I'm doing. Is that clear? Is that clear or it is not clear? Yes, Namrata, you have to check whether the entity is losing control or not. If entity is losing control, the life is very simple. You just need to, whatever FCTR closing balance is there, you just need to throw it to the P&L, right? It will be a distributable thing. But if it is not losing control, it is still having a control, then the stake which you have foregone, which you have sold out, to that extent, you have to transfer the FCTR to non-controlling interest. भाई आपका पहले लेट से 80% स्टेक था, आप 80 से 60 पे आ गए, तो जब 80% स्टेक था तो 20% एनसीआई था, माइनॉरिटी था. जब आपका स्टेक 60% हो गया तो माइनॉरिटी 40% हो गया, राइट? Right? So this will go to the minority. Is that clear? Okay. I have given you the concept. I have given you the table where you can summarize your understanding. And with this example, of course, you will be able to understand how this working has to happen. And of course, you need to solve all the practical examples from ICI study material. I have picked around 4 or 5 examples from study material, which I have discussed so far. And also my examples, just to make you guys understand. Goodwill and fair value adjustment arising from a business combination, right? So friends, for example, the company has purchased an entity, right? So probably when you read business combination, so what happens? Let me tell you. Let's say there is a purchase consideration, right? There is a purchase consideration of 1000 rupees, right? And there is a fair value of net assets of 600 rupees, right? So the remaining 400 will become a goodwill, right? So this is what I'm telling you at the time of business acquisition, at the time of entity acquisition, at the time of purchase of an entity, at the time of acquiring a stake in the entity. So first business combination will be applicable. Then what happens? On the reporting date, you will do the consolidation. So when you are acquiring any business, any entity, then you have to present the net assets, the assets and liabilities of the acquiring entity, on the basis of fair value. Sir, what does it mean? It means that, for example, the company has acquired an entity on 1st January 2023, right? And at the time of acquisition, the PPE, property, plant and equipment of that entity was 100 rupees, right? In their books. But when the company has acquired this entity, the company has revalued the fair value of the PP and it becomes 150 rupees, right? There is a 50 rupees increase, right? Accordingly, the company has paid purchase consideration. Accordingly, the goodwill has been calculated. So when you are consolidating, I'm not talking about the foreign exchange adjustment. First, I'm talking about the consolidation and business combination. So when you will be consolidating an entity which you have acquired in business combination, so how that number will be balanced? There will be, you are paying 1,000 rupees, you are acquiring assets worth 600 rupees, and 600 rupees not book value, it is a fair value, right? And 400 rupees is the goodwill. So what you will do, you will cash, you will credit equity share capital or cash, you will credit, you will debit net assets, you will debit goodwill, then this transaction will balance. So if this transaction was happened in foreign currency, right? This transaction was happened in foreign currency, then what will happen? So again, on every reporting date, you will have the goodwill. So when the transaction is in foreign currency, you have to pay purchase consideration in foreign currency. You have to measure fair value of the net assets in foreign currency, and goodwill will be in the foreign currency. And then you need to transfer or translate this foreign currency financial statement into the parent presentation currency. So you will have goodwill, you will have assets and liabilities on the basis of fair value. So Forex Standard Simple says that, Ind AS 21 Simple says that goodwill is an asset. So you have to treat this goodwill as normal asset and you have to convert it on the closing rate. Fair value adjustments to the carrying amount of assets and liabilities are also treated as a normal assets. मतलब अगर 100 रुपीस का पीपी था तो भी आप क्लोजिंग रेट पे कर रहे थे, 150 है इसको भी आप क्लोजिंग रेट पे करोगे, as simple as that, right? So friends, goodwill and the assets and liabilities at fair value has to be translated at closing rate like other assets and liability. This is the only clarification which is given by Ind AS 21. Is that clear? Is that clear? Is that clear? Yeah. Okay. And I have talked about the disposal of foreign operations, and I have talked about it specifically for the item of a goodwill or fair value adjustment as well, right? So we have, remember that we have discussed that the assets and liabilities has to be transferred at closing rate, P&L has to be transferred at average rate, equity share capital has to be taken at historical rate, opening retained earning as per the closing value, and profit for the year at the average rate. So friends, when you are consolidating foreign currency, foreign operations financial statement into the parent's currency, in that case, if there is a goodwill, it has to be restated to closing rate, right? And the assets and liabilities of the foreign operation should be at fair value, right? Which fair value? The fair value which you have taken at the time of business combination, right? And that has to be converted into a closing rate, as simple as that, right? Okay. So friends, now let's discuss net investment in foreign operations. So we understood that, let's say if I have invested in a foreign operation, right? Then what I'll do, I'll I'll acquire a stake in the foreign operation, right? For me, that stake is a investment. By if I have purchased a shares of a subsidiary, what is that? That is an investment for me. And what is that for subsidiary? Equity share capital. For that subsidiary, it is equity share capital. Is that right? That subsidiary, it is an equity share capital. Is that clear? भाई subsidiary के लिए तो equity share capital है ना वो. Subsidiary, it is an equity share capital. Friends, what is meant by net investment in foreign operations? If you are investing in an equity, then life is pretty simple, right? And let me take you this concept through the Excel file. I hope my Excel file is visible. And I'm explaining the concept of net investment in foreign operation. Net investment in foreign operations, right? Net investment in foreign operations. And what is that concept? What is this concept? The concept is, for example, A Limited India invested in B Limited USA for rupees 20,000. A Limited, Indian entity, India, has invested in B Limited, USA, in B Limited, USA for rupees 20,000, right? Now, in the books of A Limited, it will be investment. In the books of A Limited, it will be investment. This investment will be in INR 20,000, right? In the books of B Limited, what is that? In the books of B Limited, what is that? The transaction is in US dollar. In the books of B Limited, it is equity, right? It is equity. And let's say this 20,000, let's say divide by 60. 60 rupees is the exchange rate. So 333.33, right? This is pretty simple. How they will do that? Is that clear? Is that clear? Sir, if a company has invested in B Limited, right? So what you have done for that B Limited, it was an equity. Okay. For A Limited, it is an investment, right? But if A Limited has given a loan to B Limited without any plan for repayment, then what will happen? Without any plan for repayment. So A Limited has given a loan. A Limited has not acquired investment. A Limited has not invested in the equity, but A Limited has given a loan without any plan for repayment. A Limited has said that enjoy this loan, do your operations, right? In this case, if you will see, this loan, in the substance, it is a loan. So in the form, sorry, not in the substance, in the form, it is a loan, but in the substance, it is having a color of equity. Equity does not have any equity does not have any tenure. Equity does not have any repayment tenure, right? So likewise, this is having a color of equity. It is not having a repayment term. So French standard says that this is considered as an investment in the foreign operations. Investment in the foreign operations, right? In this case, although this company has given a loan, but there is no maturity period, there is no intention of repayment, right? And there is no intention of repayment. Right? In this case, in the books of A Limited, it has to be shown as net investment in foreign operation. Net investment in foreign operation, like an investment in foreign operations. In the books of B Limited, it will cover into the other equity. In the books of B Limited, it will cover in other equity. It will not cover in the loan taker. It will not be liability. In this case, it is not the asset as loan given or loan taken. It is net investment in foreign operations and other equity, right? Is that clear? And what will happen? Let me tell you. In case of net investment in foreign operation is the amount of the reporting entity interest in the net asset of that operation. An entity may have a long-term monetary item receivable from or payable to a foreign operation for which settlement is neither planned nor likely to occur in the foreseeable future, is in substance a part of the entity's net investment in that foreign operation. For example, A Limited is selling goods to B Limited, right? In that case, B Limited has to pay. So this is not a net investment in foreign operation. This is a transaction happening between a normal transaction happening between a parent and a subsidiary, right? Such monetary item may include long-term receivables or loans. They do not include trade receivable or trade payable. Trade receivable and trade payable is not a net investment in the foreign operation, but long-term loans given, long-term loans taken, this could be the net investment in foreign operation where the intention of the repayment and the maturity period is not there. The entity that has a monetary item receivable from or payable to a foreign operation may be any subsidiary of the group, right? Example, an entity has two subsidiaries, A and B. Subsidiary B is a foreign operation. entity, subsidiary B is a foreign operation, right? Subsidiary A grants a loan to subsidiary B. Subsidiary A's loan receivable from subsidiary B would be part of the entity's net investment in subsidiary B if settlement of loan is neither planned nor likely to occur in the foreseeable future, right? Is that clear? Friends, if there is a net investment in the foreign operation, then what would be the treatment in the standalone financial statement? Let's say A Limited. It is a parent, right? B Limited. It is a subsidiary. It is a subsidiary. So A Limited has given a loan. Subsidiary has taken a loan. Now this is considered as a net investment in the foreign operation. Why? Because the repayment terms are not there. The repayment timing are not there. Maturity period is not there. So what happens in the books of standalone financial statement of parent and subsidiary? So this will be the monetary item. This will become the monetary item, loan given, loan taken, right? Forming part of entity's net investment in foreign operation. And in standalone financial statement of reporting entity and foreign operation, whatever is the exchange difference, it has to be recognized in the P&L. Is that clear? It has to be recognized in the P&L, right? Is that clear? It has to be recognized in the P&L. What will be the treatment in consolidated financial statement? If that net investment in foreign operation is a monetary item, right? If that is a monetary item and that monetary item form part of the net investment in a foreign operation, then the foreign exchange gain and losses will go to OCI. As simple as that. If it is not if it does not form part of the net investment in a foreign operation, then it will go to P&L. Sir, what does it mean? If A Limited has given a loan to subsidiary and that is not a net investment in the foreign operation, means this loan has to be repayable within a period of 5 years. In that case, it is a foreign currency transaction, right? It is a foreign currency transaction. So whatever exchange difference will be there for translating this foreign currency transaction into the closing rate, in that case it will go to P&L, right? It will go to the P&L. Doesn't matter, be it standalone, be it consolidation, right? भाई अगर मेरा वो नेट इन्वेस्टमेंट इन फॉरेन ऑपरेशन नहीं है, अगर वो लोन ट्रेड पेबल, ट्रेड रिसीवेबल, तो क्या होगा? एक्सचेंज इंपैक्ट कहां जाएगा? P&L में जाएगा. बट अगर वो मेरी इन्वेस्टमेंट का पार्ट है, वाई? बिकॉज कोई रीपेमेंट पीरियड नहीं है, कोई मेच्योरिटी पीरियड नहीं है, तो मैं उसको लेके कहां जाऊंगा? अदर कॉम्प्रिहेंसिव इनकम में लेके जाऊंगा. वाई OCI सर? बिकॉज if something which is not net investment in the foreign operation, it means it is a transaction of routine nature where you need to recognize the gains and losses. But if something which is in the nature of net investment, for example equity, there is no repayment period, it means it has to be for a long time, right? So there is no point for recording the income and expense in the P&L. It is more of a notional nature, right? That is why it has to go to the other comprehensive income. Is that clear? Is that clear? Yes, you're right, Namrata. Loan is like an equity. Let's discuss this case study. Foreign functional currency of parent P is euro, while the functional currency of subsidiary is USD. P is euro, subsidiary is USD. P sells inventory to S, and a transaction for the same was made for $300 during the year. At the year end, a balance of the same amount is outstanding as receivable from S. It has been observed that such balance amount has been continuing as receivable from S year on year, and even though the payment in respect of these balances are expected to be received in the foreseeable future, but if we look at the year end, then we see this balance as outstanding every year. So what happens? P used to sell the inventory and S used to make a payment. And normally P sells the inventory of $300. So what S does? S got the consignment, S sells the consignment, and S pay the money to the P. So although the transaction is of a rolling nature, right? So one purchases, one sale, one purchases, one sale. But what happened? Transaction is of rolling nature, but every year end, the balance of $300 is outstanding. So it does not mean that this $300 is not payable. There is a coincidence that this much money is always outstanding, but it is not related to the first transaction. It is related to the last transaction, right? So this is a normal trade payable and trade receivable. This is not a part of the net investment in foreign operations, right? In addition to this transaction, the trading balances, in addition to trading balances between P and S, P has lent an amount of 500 US dollar, right? P has lent an amount, P has given a loan of 500 US dollar that is not expected or to be repaid in the foreseeable future. That is not expected to be repaid or repaid in the foreseeable future. Should the exchange difference, if any, be recognized in the profit and loss? Tell me. So this is the part of the net investment in foreign operations, right? The exchange gain or loss will arise in account in the books of P in respect of trading balance with S, and the same should be recognized in P&L. This being a balance for the nature of trade receivable for P, it would not be considered as a net investment in foreign operation. The amount of loan given by P should be regarded as its investment in S. Thus, the exchange gain or loss incurred by P on 500 US dollars should not be recognized in P&L in P's separate financial statement and in other comprehensive income, and it has to be recognized in other comprehensive income in the consolidated financial statement. Is that clear? So basically, in the separate financial statement, it has to be recognized as a gain or loss in the books of P, right? Because it is a monetary item. But in the consolidated financial statement, it has to be OCI. So friends, if there is a net investment in foreign operation, please remember, if there is a net investment in foreign operations, right? Net investment in foreign operation. Just a minute. Yeah, net investment in foreign operations, right? Foreign operations. In standalone financial statement of parent, it will go into the P&L impact. In consolidated financial statement, it will go to the OCI, right? Clear? Coming to the tax effect, of course, whenever you are translating your foreign currency transactions or you are translating your foreign currency balances, there would be an implication of deferred tax asset and deferred tax liability. So day after tomorrow, you will have a session on income taxes, right? Deferred tax asset and deferred tax liability. So you have to create this DT and DTL on these transactions. Okay. Disclosure I'm not covering. Now let's take some multiple choice question. Then if you have any query, I'll discuss that. Dash is the currency of primary economic environment in which the entity operates. Foreign currency, functional currency, presentation currency, local currency. What is the right answer? What is the right answer? Yes, functional currency is the right answer. Functional is the currency of the primary economic environment. Yeah. B is the right answer. The reporting currency of the parent is US dollar. Subsidiary is INR. In consolidated financial statement, the subsidiary balance is to be translated in which currency? I'm not getting a response from the students. Students, am I audible? Am I audible? I'm not getting a response from all of you. Okay, now I got 3 response. Yes, US dollar. While translation from subsidiary balances into the currency of a parent, while consolidation, the exchange difference will go to P&L, OCI, TCI, statement of changes in equity. What is the right answer? Yes, it will go to OCI, other comprehensive income. Which of the following is not an example of monetary item? Pensions and other employee benefit to be paid in cash. Provisions that are to be settled in cash. Cash dividends. Property, plant and equipment. What is the right answer? PP is the right answer. PP is the right answer. D is the right answer. Okay. The effect of a change in functional currency is accounted for. Hence, in the last class, I have told you, when there is a change in functional currency, change in functional currency is considered as a change in estimate, but change in presentation currency, it is considered as change in policy. So change in functional currency has to be applied prospective. Change in presentation currency has to be applied retrospective. Right? So prospectively is the right answer. Right? Thank you, friends. I have covered entire concept with the help of examples and case studies on Ind AS 21. I hope you find this session useful and I hope you have enjoyed the session. Please let me know if everything you have understood whatever I have explained so far. Thanks, Rohan. Thanks for such a nice feedback. I'm glad. Thank you so much. Bye-bye. Take care, guys. Namrata, what is the logic of the last question answer? So, Namrata, change in functional currency will always be due to the facts and circumstances, right? For example, if in the last year your major business was in USA, so your US dollar will be the functional currency. But in the current year, your major business is in China, so your functional currency will be the Chinese yuan. So it is on the basis of facts and circumstances. That is why you have to apply the changes prospectively. But if I talk about presentation currency, this is something which we have decided, right? So if today I have decided, no, I have to translate into euro so that my financial statement will looks good, okay? Because the euro is a stronger currency, so I'm just playing. I am a global company. I'm playing just with the help of a presentation currency so that my number will look good, okay? So in that case, since I am deciding, right, my functional currency is different, but I'm deciding my presentation currency. In that case, standard says that no, this will be considered as a change in policy, and you have to restate your retrospective numbers, and you have to give the third balance sheet, and you have to apply the principles of Ind AS 8 as well, right? Is that clear, Namrata? So thank you, students. Thank you so much. Bye bye. Take care.